Hello. Let's work on the Glover Corporation question. The company purchased bonds with a face value of $300,000 and they paid $307,493.34 for it. So this was purchased at a premium. We are required to record journal entries to record the purchase and the first two interest receipts and the sale of bonds. So this company went out, bought bonds, and they will be receiving interest based on the schedule that is specified on the bonds. So the bonds are paying interest twice in the year, semi-annually on June 30th and December 31st. So first off, let's start with the first entry is to record the purchase. So we have an investment in held to maturity debt securities. So the first journal entry, investment in. So I'm going to for this chapter, I'll be doing using abbreviations because of the relatively lengthy names. So I'll be using HTM for held to maturity. So investment in held to maturity debt securities, and we invested $307,493.34, and we had a debit to cash, so we paid out $307,493.34. So that's for our original purchase. Next, we need to do we need to record the interest, the first two interest receipts. To do that, we have to do an amortization schedule. So this is similar to the examples and the exhibits that we have in the textbook. Make sure you review those before working on these problems or on your homework. So first, we do start with the carrying value of the debt security, which is what we paid for it. So we start off, if it was at a discount, it would be less than the $300,000, but for this example, it was at a premium. So we start off with what we paid for it, $307,493.34. Every 6 months, we will have interest, which the interest payments every 6 months will be based on the stated rate on the bond. The bond is stated at 11%. Actually, that's the yield. The stated rate is 12%. So we have 12% times 300,000 times 6/12, because we're doing we are having payments every 6 months, so we'll receive this amount here every 6 months. So that's how we're getting our first column here. That's based on that calculation. So we'll get 18,000 every 6 months. So this is for the purchase date was January 1st, 2016. On June, we get 18,000. In December, we get another 18,000. So that's our computation there. For the interest income, we base this on the yield rate. So the yield rate, we have that as 11%. So for the first computation, let's call this B. The first computation, we have 11% multiplied by the last carrying value. The last carrying value, the last time, that's the last balance on this column, the previous one, is 307,493.34. And we're going to multiply that by 6/12. So that's how we're getting this column. So we're taking the carrying value times the yield rate, and we multiply that by 6/12 because we're doing this every 6 months. So we have 16,912.13, and we have 16,852.13. 0.30. So the first one is that there. The next one will be this number here times 11% times 6/12. That's how we're getting this. But let's proceed first to complete this line. So this, we get the interest here. We'll take the interest income and subtract the cash. So the difference between these two will be our amortization amount. So our amortization amount, $16,912 and 13, subtracted from $18,000, we have $1,087.87. We take the $307,493 and 34 cents, and we subtract the $1,087.87 to get the next number here. So we're amortizing the premium, which is the extra $7,493. As we go down this amortization schedule, we'll end up with $300,000 on the bottom if we do the whole amortization. But for the sake of this question, we just need to do the first two. But if we completed all of it, then we would end up with $300,000 on the bottom. So we would amortize all the $7,493. So the next payment, when we take this, subtract that, we now have $306,405.47. We repeat again what we did on that line. So we already did the cash payment. For this one, we had $306,405.47 times 11% times 6/12. We get this. Now we take 18,000, subtract 16,852.30 to get our amortization amount. Our amortization amount in this case is $1,147.70. We'll take this and subtract the amortization amount. So when we take that, subtract that amount, we now have $305 and 257.77. So this is the carrying value in our balance sheet at the end of 2016. We have this investment being carried at $305,257. Now let's record these two interest payments. So for June 30th, and the year is 2016, we have a cash receipt. So we receive cash, not that we invested. So the company that we bought the bonds from is giving us $18,000 every 6 months. We have interest income, which is our column here of $16,912. So $16,912.13, and we have the amortization of the investment. So investment in HTM securities, in held to maturity securities, and that's what we amortized for the first 6 months, $1,087.87. So that's our first interest payment. And then we have our next interest payment on December. So December 31st, 16, we have cash again of 18,000. So we're getting this from the table we already completed. We have interest income of 16,000. So 16,852 and 30 cents. And then we have the amortization investment in, so the decrease for the premium is $11.47 and 70 cents. On And we are also told that on January 1st, 2017, in contemplation of a major acquisitions, the bonds were sold for $300,000. Well, just a note before we address this for this specific question. Investments are classified based on management intent, and the L to maturity were classified that way based on the intention to hold it until it matures. So a reclassification is usually rare, and sale of an L to maturity security is rare. So it's usually rare. This should not happen often because it brings into question management's intent or judgment, because at first you classify this as L to maturity. Why are we selling this at the moment? So let's record that transaction for the sale on January 1st, 2017. So on January 1st, 2017, we sold the security for $300,000. At that time, we had amortized it down to $305,257. So we need to remove this from our books, and it's on the asset side because it's an investment. So to remove it, we do a credit to investment in HTM. So investment in L to maturity, we do a credit of $305,257.77 to remove it. The difference between what we received in terms of cash when we sold it and what was in our books is a loss. So we did incur a loss for the difference. The $5,257.77 is loss on sale of HTM. Held to maturity securities. So we have a loss for that amount. The last part is asking to discuss considerations involved in when HTM debt securities are sold prior to maturity date. So I discussed this with a little bit. So we do not, it brings into question, again, it does bring into question management's intent, because when they were classified during acquisition, it was with the belief that management judgment as to the intent to hold this was true. So this sale would be questioned, as it would bring into question management's intent and changes to prior decisions. So that concludes this problem.